Hey everyone, my name is Ashan Sandir and I'm the Chief Executive Officer here at Eagle Investors. Today we have the pleasure to sit down with the top derivative expert, Felix Fry, to discuss the market and answer important options questions. Felix is an experienced Wall Street veteran with over 20 years of experience. He formerly worked as the Executive Director of Equity Derivatives at Bank of America in New York. So without further ado, we hope you guys enjoy. Thanks.
We're seeing increased volatility with the coronavirus. In terms of dealing with market volatility, what would you say is the best way for retail investors to deal with volatility?
Sure. Why don't we start with, volatility is the driver of option prices, right? So as the realized volatility, so as the markets start moving around, the option prices, they'll go up, right? The implied volatility simply means that they'll go up. What usually tends to happen is you get this spike, which we had a little bit of, it was about a month ago, and then things calm down, and then it's like volatility begets more volatility, right? You need to break that cycle of 10 years of volatility just going straight down, and it doesn't just go up usually in one shot. Usually, you get this spike, come down, and then usually it's like volatility begets more volatility. The way the way you should probably start thinking about it is it's a warning sign, right? It's like this, that January spike was a warning. It was basically saying, things are, things were smooth, and then all of a sudden there's something rocky going on underneath the hood. How do you think about it as far as price? I would say that at the end of the day, I'm going to look at the price of the options. I'll give you an example. I've been talking to many people who've had questions about Tesla. They've made a lot of money in Tesla, right? And after making a lot of money in Tesla, what do you tend to do? You tend to go back into Tesla and start playing around with different strategies, different things. Yep. And what I would say, I joke around with them and I say, in Tesla, the price of poker just went up, right? You were playing a game where Tesla wasn't really supposed to go through, let alone 300, 400, 500. It wasn't supposed to get to 6, 7, 8, 900. And it's certainly not supposed to go up and down 100 points every day, right? And so 2 months ago, you were able to buy Tesla upside calls or downside puts at a fraction of what you can pay today, right? And that was because it hadn't made the move. And so people bought the calls, they caught the after the earnings, they caught the move up, and it just kept going up, up, and up, right? And, now they've made a lot of money, and they're starting to buy options in different places in Tesla. And the way to think about it is, if you don't have a system for choosing which option you're going to buy, which is what I teach, you will start to bleed money over time. And in the high volatility environment, the market makers, they know that there are buyers. They know, first of all, the market makers know that a lot of people made a lot of money. And so now they can raise the volatility higher until the institutions decide they want to sell it. They could just raise these volatilities higher. And what happens is the retail investor starts paying these higher and higher prices, which are implying larger and larger moves, which makes it much harder, much, much harder to actually make money in Tesla over the next, call it 3 months. So I would say for the retail investor, if you're buying options, you got to take a pause. As volatility rises, you have to take a pause, and you have to be very specific about what you are buying. So if you're selling options, there's probably more opportunity right now as the market goes up, as the volatility pushes up the option prices. So if you have your favorite stocks, now's the time to start thinking, okay, maybe now's the time to start thinking about selling something, or doing a spread or something to reduce some of that premium. I personally still like looking for those opportunities, because I think high volatility, where someone is actually paying that volatility, still can lead to very big gains. So I'm not afraid to pay high volatility, because at the end of the day, if someone is paying that volatility for a lot of options, it shows you how much risk is actually embedded in the stocks. So it's a catch-22. There's no sure answer. Just higher volatility should make you sharpen your pencil to make sure you know exactly what you're doing and the exact time period you're looking for.
Yeah.
Okay, thank you.
Yeah, and this is a great question. I just want to add a little bit more on top of it. So I just want to say that before I'm a trader, I'm an investor at heart. And as an investor, what I believe is that the market will be higher one day than it is currently today. That's my general thesis as a bull market investor, if that makes sense. And what I would say is that at all times, my core position is long on the market as an investor. However, during times of volatility, I will add and subtract hedges as I see fit. So for those who don't know, a hedge is something that offsets risk. So for example, if you're buying stock in Apple, you might want to possibly sell calls during times of potential volatility to make a profit off that and just hedge yourself. So for example, if Apple reverses, then maybe we want to buy back the calls that we sold and just ride our core long position. So again, what I try to do is, my entire investment portfolio remains long. And at certain points, I'll use options and other types of the derivatives to hedge my risk and to add and subtract those as I see fit, depending on current market condition and sentiment. So I hope that helps, Vishu. Awesome. Cool. So I want to go to our next question. And before I do, I just want to remind everybody, and again, welcome everybody to our live Q&A today. If you'd like to ask a question, please direct message me if you can on Discord so I can unmute you and we can get to your question. So I know, Felix, we have a lot of our 3 Steps to Profit membership has been doing a lot of people and a lot of members have seen a lot of interest. And I think they're getting a lot of value from it recently, especially in the last 1 to 2 weeks here. I did have a question from one of our members. His name is Jesper from Denmark. He's one of our 3 Steps to Profit members. He couldn't make it today because it's middle of the night out in Denmark today, but he did have a question which he wanted me to ask, and I told him I'd promise to relay it over to you, Felix. So this is a question that we've been getting a lot. It's the basic question. We even went over it in the last webinar. It's how do we find that stock? So let me just tell you the whole question here, and maybe we can break it down a little bit. He said, what are the different moderators? And I think, Felix, you would be incorporated in the traders here and the moderators. What is our approach from thinking about taking a trade to pulling the trigger? Example, how in detail do the mods find the stocks? How do you pick them and sort them? And how do you make the final decision? So pretty much what we're asking is, hey, how can I find that stock to make that option play on? So I know it's a really tough question. This is the question that everybody asks, but Felix, I'm wondering maybe you want to get started and I can add
I mean, look, I think there's several ways to think about it. One is to simply do as much research as you can on the stocks that you like. So when the opportunity arises, you're ready to take advantage. That's just a general approach. I know Apple, right? I want to be long Apple, but I want to be long Apple at 170 again, right? So, now I think Apple has a long way down if China and the coronavirus actually keep spreading and things, start really affecting U.S. companies. And I tend to know a little about a lot of stocks, right, from doing research each day. So the first is just to read as much as you can, news, financial statements. When you get a chance, read articles, interesting articles, find good writers that are writing about interesting topics. And just absorb as much as you can to have general knowledge about certain stocks. That's what I would say first. When I'm playing options, and I mentioned this the last time, options are a game. I'm a buyer of options, and options are a game that needs movement. It needs outsized movement. It's not good enough to just think that Netflix is going to go up or down, or Apple's going to go up or down. We have to be more specific and say, what, I think it's going to go up or down a lot. Okay. Now, where do I find these trades? So what I do is I let the market tell me where these trades are every day, right? I let the market tell me where the hedge funds are playing, right? If you're, it's a perfect example. It's you're out and you're looking for the sharks in the ocean, right? And you're looking for great white sharks. Do you go off the coast of New York? No, you kind of know, like, hey, there's not going to be many, although there has been one over the last, couple of years, a great white shark floating around the East Coast. So if I'm going to look for a great white shark, I'm not going to look on a boat in New York. I'm going to go to South Africa. I'm going to go to, off the shores of Japan and Australia. I'm going to where the sharks are, right? Where the sharks are swimming around. In options, the sharks are swimming around in the unusual options activity, right? If you want to know where the sharks are going, if you want to know where they're putting their money to work, the easiest place to look is unusual options activity. So I would find a great place that has unusual options activity, and then you're going to have to filter down because there's too many. So once you know, all right, well, the hedge fund guys, the guys with the big ideas, right? And you got to think about this. If I have a big idea where there's going to be an outsized move, where do I go? Sure, I'll buy some stock, right, if I think it's going up. But if I think it's going to be this outsized move that the market's not aware, then I'm going to look at options because I want to leverage that bet. I want to make the most money I can off that bet. That's how hedge fund managers think, okay? And as an investor, that's how you should think. If you have this opinion on what the coronavirus could do to a stock, then you can do your analysis and then buy, for example, puts on RCL or CCL. And you could have done that 3 weeks ago when it made its first dip and the coronavirus was still sort of getting going. But if you sort of thought through the process, you'd find, you know what? People are buying puts. They're buying size puts. And maybe this is a little bit bigger. And now the risk reward is in my favor. And so putting together the story with unusual options activity, with what's going on in the world, that's how you start piecing together why might somebody be active right here? Why are the sharks roaming around CCL and RCL? Why are they roaming around, HLF and New Skin? Why? Because there's a lot of earnings coming out of China in these stocks. RCL, CCL. Obviously, if people are not getting on boats, these companies are a little bit in trouble here. So, I think the question's a great question. Where do you find these pool of stocks to trade? And I think unusual options activity, is a great start. But it's a large pool. And so then you got to filter it down. Now, filtering down these trades is what I teach at 3 Steps to Profit. So Jesper is a member. He can email me at any time. But I go through a very specific process to get, there's probably 150 to 200 of these trades a day. And I go through a very specific process to filter that down to about 15 trades, right? So imagine 200 trades that are potentially sharp trades or guys who have edge. And I can narrow that down to 15. And from the 15, I can find 5 that I have general knowledge in and general understanding of what might be the issues. And then I can start digging into those 5. That's a lot different than looking at 200 trades. And so, the answer to that is, have general thought. Unusual options activity could trigger some of that thought. You could see the actual trades that are going on live. You match that up with charts. You match that up with what's going on in the macro world. And then you have your pool of 4 or 5 trades. And then you can start thinking about what the charts are saying, where they think it's going. And Jesper now has access to the new options chain, which allows him very simple. I mean, look, here's a perfect example. Yeah, on Friday, and Jesper knows because I gave him, he's gotten the email. But on Friday, I'm watching the tape and I'm seeing things very heavy. Okay, I know what's going on in coronavirus, but that's been going on for 3 weeks. Like, what makes today, the day? Well, at the afternoon, there was no lift in the whole market, right? Stocks were getting hit. Microsoft was down pretty big. Some big guys, big stocks that were really heavy, and the market was heavy. And the volume in the SPYs was trading up. It was big. And I just thought, you know what? It doesn't feel well. It doesn't, the feeling wasn't there. So I looked at the SPY chart and I saw this MACD diversion, okay? The MACD diversion in the SPY chart, essentially in January, the SPY made a high, okay? The MACD also made a high, right? If you look at February, going to February, the SPY made a new high. The MACD didn't make a high, which is what? If you think about MACD as the the force of the move, right? The first January move, high, MACD's high, that's good force. The second, the price shows a high, again, it should show a MACD high force. It didn't. It showed less force. It was less power behind that move. And when it starts moving back the other way, which if you look at the SPY chart, it's starting to move back. That is a clear, it's a clear MACD diversion, which shows me weakness. So now I'm combining that weakness, okay, with what's going on in the macro world, with what I'm seeing with Microsoft and Apple and some of the bigger names. And I'm saying, you know what? This could be this doesn't feel right. I'm going to take a look at the SPY options board. So what I did for the OptionsGeek community, I sent an email out at about probably 1 o'clock, 2 o'clock, and I said, it doesn't feel good. This is what I see. And for the members, I said, for the Winning Picks members, I said, I want you to buy puts the March 2nd, which is not this Monday, the following Monday, March 2nd, 3:30 puts, and I want you to pay $2, and I want these on. Like, I don't want you to think about it. I want these on. We need these on. This is big. Monday could be a disaster, because that's how these usually, when you get that MACD, it's either wrong signal or it could drop pretty significantly and pretty fast. So from beginning to end, I wasn't thinking about buying puts in the SPY on Friday, but I just started seeing seeing different parts of the market. I looked at the chart. The chart was showing me this MACD diversion. And I took a trade by looking at the new options chain. If you look at a SPY chart, you could see, I think it could easily get to 315, 320. 320 is a big level, but 350, it can get to 315 quickly. Okay, it could get out of control quickly. And so I thought to myself, you know what? If I throw in the new option chain 321, 320, what does that give me? It came out, and I wanted March 2nd. It gave me the 330 line, and I said, that's great. I'll take that trade. And I sent out that trade. So our members are long the 330 puts in the SPYs from Friday at 2 o'clock. But that is from beginning to end how, you can come up with an idea and execute on an idea.
Wonderful. So Felix, one thing I just want to add on to that, I know you mentioned unusual options activity and unusual options volume. Something we did add to the 3 Steps to Profit membership is a new software we call it Option Bot, if that makes sense. So
sure.
Within the channels, what you can do is you can type in a certain command, and we have about 1,000 different commands. One of these commands I'm looking at right now is just unusual vol. You type that in, and what it returns is the top 10 stocks with unusual volume, top 10 unusual options volume, top 10 the most volume on what contracts in the entire market, etc.
Yes.
So this is something in conjunction with the 3 Steps to Profit. I know you're always talking about, especially in the education course, unusual options activity and stuff like that.
Great.
If you guys are really looking for somewhere, there's a bunch of different services. You have FinViz out there. You have some different ones. We also do offer that, and we've been working hard to be able to bring that to you guys. So
that's great. That's awesome.
And Felix, I have to give you access to that as well. You might like it as well. I'm sure you will. So
perfect.
I'll make sure to just unlock that to you guys. But if anybody is interested in getting a quick taste of that, we can give you a quick free trial on that option bot for 1 to 2 days. Just see, if you guys like it. Just shoot me, as I said earlier, shoot me a direct message on Discord, and I can unlock that for you guys for 1 to 2 days and see. If you're interested in that 3 Steps to Profit add-on there. So, so the next question I wanted to go to, I think we have Oliver in here as well. And we also have a few different ones lined up, but I want to go to Oliver over here. Oliver, can you hear me?
Yes, can you hear me?
Okay, wonderful. Yes, we can. So do you have a question for us today and anything you wanted to talk about?
Let me think. I guess you already covered the one that I was going to ask. Aside from some of the other things mentioned, what are some stocks of interest? I know last time you mentioned Gilead, which makes sense. I like Clorox. Clorox is good. Clorox?
Clorox.
Yeah.
Wow. Bleach?
Yeah.
Exactly. I know my fiance is bleaching every doorknob every 8 minutes. I think this could be a big turn in the market. So I'm trying to, in what we do at OptionsGeek, we're trying trying not to pick the direction, but I'm very cautious that, for the last 4 months, the market's been going just straight up. And, I feel like if out of 10 trades, if I'm picking 4 puts and one of them works, it's sort of, it's great. It makes up for the other 3 puts that probably don't work, and then we got the calls working for us. But I've been switching the portfolio a little bit towards the downside. I'm a little bit concerned that the market, it works until it doesn't work, right? It goes up until it doesn't go up, and then when it goes down, you get a violent move down because people get caught off sides. The market gets caught off sides, right? So I am looking at gold stocks, upside in gold stocks. I'm looking at plays like, and here's the other thing. You think you missed it, right? People think, Apple's down 15 off its high. I don't think you missed it. It's one of these things where you have there's a lot of people in the market over the last 6 months who are inexperienced, who believe that if a stock is down $40, it should come back up. And I'm very cautious here, and I will be watching over the next couple of days how, the market handles these types of, everybody's conditioned to just buy this dip. But when the institutions decide to turn and to get out, it's this inexperienced trader that's going to be left holding, Apple at 310 when it's trading 260 again, and it's going to take 2 years to get back to 310. That could happen. Not saying that it would, but I think the market is still undervaluing these options because it could get violent pretty quickly, and the machines are. Remember the part that is a little scary, and I read a lot about it over the last a couple months, but high yield, the bond market's a much bigger market, and the FX is a much bigger market than the stock market, and most people don't fully appreciate that. But if the bond guys are getting nervous, that's when you gotta get a little nervous yourself, right? So high yield is one of these areas where spreads, the way you look at bonds, you look at the spread to treasuries, and it's at record lows, and it's just been trending that way for a long time. But high yield stocks are high yield. They're called high yield because they have a lot of debt, right? And they're servicing a lot of debt. And if you have a breakdown in, you have this event, call it coronavirus, and supply chains stop, or and it's longer than 2 weeks, and it becomes 2 months or 6 months. You have a lot of companies. The debt doesn't stop being serviced, right? It's business stops, but and there's no cash flow coming in as a company. So how do you start servicing these debts? One of the key things that I was going to watch tomorrow morning was like an index like BKLN, right? BKLN is one where people are concerned because these, the high yield market, these bonds, it's not like stocks. When people want to get out, some of these things trade on appointment, right? So there's no liquidity, so they just get marked and marked and marked until what happens is you get someone that has to sell at any price, and it just goes lower and lower and lower. When these bonds get marked lower, then these ETFs just go down in big chunks. And so they're talking about potential illiquidity issues in a lot of these ETFs where a lot of money is parked. And so there's issues, right, in the system there that, I will be looking out for if we start moving down. Remember, we were down 1% on Friday, and it felt pretty bad, right? That was 1%. It's just people are so accustomed that the market moves up or down, usually moves up 1% or down 10 bips, right? Mm-hmm. Market was down 125 basis points. It felt bad. Like it just felt bad, right? You had like Microsoft down, Apple down, big numbers, and the market in general is down 125 bips. The market could be down 300-400 bips. It happens. And, if it was down 300-400 bips, you're talking about the SPYs down 15 handles, 12 to 15 handles, 11 to 15 handles. That would be a lot. That would be a lot for, SPY trading, tomorrow at 320. How would that feel? You'd have Microsoft, Apple down 10%, so that's where, this air pockets, if you will, like you get, on Wall Street would say offsides, like, okay, penalty, offsides, like everybody's leaning long. Everybody thinks every stock is going to the moon. And then it's like offsides, it's like reset. And it's like, oh my gosh, somebody asked me, because this Friday I was feeling in 1999 during the bull run, I literally turned $3,000 into almost $2 million. Okay. I was a young kid on Wall Street. I was just making way more money just playing around the stock market than I was actually at my job. Right. And I remember the day, I don't remember the date, but I remember the day that the market went down, and it was a Monday. that's why I sent this email out on Friday. It was, I felt the same. There's a Monday. I was so long. I was 20, how old was I? I was about 26, 27. I was so long the market, so long calls. And it was uncomfortably long. And I went home Friday thinking, man, I'm really long. And everybody in the room was really, really long. And on Monday, the NASDAQ was down 3-4%, but that didn't the whole story. The story was the individual stocks that we were all long were down $50, $180 stock. Now the stock went from 30 to 180, and then that Monday it went from 180 down to 130. It got destroyed. So you might see that day sometime soon where the market's only down 3%, but each individual stock is down, 15. It could get that violent. And so that's something that you haven't really seen that much of. There was the flash crash a few years ago, but that's what wakes people up. That's what says, oh my gosh, like what just happened? Everything went down. AMD's down $15. How can that even be possible, right? And people are buying it down 3, down 6, down 9, and then they're getting stopped out down 12, 13. Those are the violent days. Those are the days that are inexplicable to the young investor to say, yeah, I'm a buyer, I'm a long-term buyer. You're a buyer until, TD Ameritrade's stopping you out on your whole portfolio because you were leveraged, 1.8 to 1, and you're literally, things are down significantly, and that's when the pressure's on you. Like, you can't hang on, right? It becomes tough to hang on. So, to answer your question, what I don't like the market here. I'm playing it very cautiously on the upside, and I'm trying to jump in on those puts, because, if this is that moment, those puts explode. And, look, I've been buying puts with the membership for, the last, call it 2 months. And I'll take the hit. I'll take the hit once. I'll take the hit twice. And we're getting stopped out at 50%, 60%. And people are like, why are you still buying puts? It's like, because when we win, we're going to clean up on, the 50, 60. You're not even going to think about that anymore. When it turns, that $1, $2 put's going to turn to 15. You're going to make 600, 700%. It's just, you got to play the game while the game's being played, right? So we're, at OptionsGeek, we're always long these puts. We're always long. It doesn't matter if the market's going up every month. We're long puts somewhere, to make sure that, in a crash, in a flash crash, we're going to make some money to recoup back either the calls, or we're actually make more money than what we lose in the calls. So to answer the question, I don't like the market in any sector almost. It's almost everything is too expensive.
Oh yeah.
No, but I don't, to be honest, I try not to think. People always go, how do you pick this stock? I say, I try not to think. I try to let the market tell me. And, Gilead, somebody says, they're always like, do we get out now? I don't know. I didn't know anything about Gilead before. I don't know anything more now. I do know that we paid $1.20. It went to $4, three and change. And you should have got out of some, right? It went from $1 to $4. When something's moving like that, you get out of some, and you can leave some to let it ride. But, I don't know anything that right? I'm an expert in sort of finding those pockets of great, I'm not trying to say that I do, this great research on a company, and that's why I'm doing so. I'm an expert in spotting the shark and then sticking a rope on it and sort of like, following along for a while. That's what I do.
Can we call you Fonzie?
What's that?
I said, can we call you Fonzie? Jump the shark.
That's funny.
Exactly.
Thanks, man. All right. Hey, one thing I just want to add really quickly, and just a quick lesson for anybody who wants to quantify a little bit about what you were saying about markets only down 1%, but Microsoft's down 3%. Why is this stuff happening? So the topic is called beta. It's BETA. And what beta is it's the correlation of a security to the overall broader market. So if something has a beta of 1.0, that means it's just as volatile as the market. So for example, SPY, we would say has a beta of 1.0. Then we go on Microsoft, right? We'd say Microsoft has a beta of maybe 3.0. That means Microsoft is maybe 3 times as volatile as the overall market. So this goes both ways. Market's up 1%, Microsoft up 3%. Market down 1%, Microsoft down 3%. And usually this is compounding, calculated over like 3 years and averaged monthly. But this is something that I usually take a look at, especially in regards to investment portfolios and stuff like that, because we have to make sure that we're balancing high beta assets with low beta assets, and we want to make sure that we have that perfect balance depending on our market sentiment and stuff like that. So again, it's the I think 3-year calculated monthly beta, BETA, and it's a really, really good just stock and investment concept.
You're right. It's a great concept for sure.
Yeah, awesome. So I just want to go to a member question that we have here. It's from Hope. She just put it in the chat here. She said, I know we're just talking about it right now. Do you think SPY goes down for short term, 1 to 2 weeks? This is what I've been expecting for the last 3 weeks, but whenever it goes down in the morning, it comes right back up. Do you think this is real downward momentum? And I know it's a tough question, but what do you think?
Yeah, I would say, look, I hate calling the market. When someone says, where do you think the market's going? I tell them, if anybody tells you where it's going, they're guessing. I mean, no one knows, right? But at the end of the day, what we do know is we can find trades where the risk reward is one, it's manageable, and it seems to be in our favor. So I agree. I've experienced the same thing, as Hope. Is that it?
Yes,
and
Hope.
You wake up, the market's down by 10:30. It's right back to almost unched, right? And it's like, what's really happening here? At some point, that point may be tomorrow, but at some point it breaks. Or at some point, the market has a good way of putting you to sleep, right? And once everybody's asleep, it's like that, I literally had an email that outlined the whole thing because I had the same conversation. It puts you to sleep, and it's like a tsunami coming. And when you look at a tsunami in the horizon, right, it looks like just a tiny little wave, right? And everybody's playing in the water. But as that tsunami is getting closer, it's like, in comes the sea, and then all of a sudden it's this 100-foot wave you can't get out of. So at the end of the day, this might be the tsunami. I don't know. I do know that the options are mispriced for the risk that is out there. And I think that's what you're seeing, and that's what you're hearing from some of the bigger managers. They're long. They're paid to be long. It's almost what Sean said. They're paid to be long, right? You're a manager, you're paid to be long. But when they start seeing these signs, what they do is they get out of their stocks and replace them with either call options. Okay, so they might for example, there was hundreds of thousands of Microsoft call options, the 185s to the 200s over the last 3 weeks. And everybody's been getting long Microsoft because unusual options activity and all this is happening. But at the end of the day, I thought my first impression was Microsoft. I mean, to me, it seemed like it would be smart if I was long 10 million shares of Microsoft to go buy 100,000 options and sell all of my stock. And if Microsoft decides to get crazy and go up to 210, great. But you know what? I just rode Microsoft for 60 points. I'm going to sell my stock. I'm going to buy some calls, and I'm going to call it a day. That's great risk reward. Now I'm freed up with cash. Microsoft's down 15 and probably down to 20 from the highs tomorrow. Now I can start nibbling wherever I want to nibble, and that's what these guys do. So, is the momentum there? Yeah, there was 100 million shares, 100 million SPY shares traded. There was, Microsoft was down significantly. These things are trading. They traded like a straight, like an arrow in the last week, straight up. So, I think that I don't know if this continues, but I do know that the market has mispriced the risk and how far it could actually go.
Yeah. And let me just add to that really quickly with some real-time news here. So, you have your futures that open. They're currently open. You have all U.S. futures selling pretty bad, -1%. You have the Nasdaq down 1.6%. Looking at world indices here, we have decently developed countries such as South Korea, Australia down over 2%. You have Asia not selling as hard. Maybe that's some relief for them because they've already been selling so hard recently. But doesn't seem like the selling is stopping. One thing that I would say is that currently the sell-off is happening, and what I like to do from a technical perspective and what I do on my charts is I don't want to catch a falling knife. And that's a very common saying is if you catch a falling knife, you're going to cut yourself and you're going to bleed. You want to wait until the knife hits the floor, and then you want to pick up the knife from the floor, if that makes sense. And what I do is I look for the bottom, but not just the bottom. I look for a confirmation of a reversal before going long. So there's many different, concepts on what is a confirmation of a reversal. This can be a bullish engulfing candle on the 4 hour, on the 1 day, whatever it may be. You see a lot of buy volume returning. You heard, you see the market up 2%. You see a strong V formation of a reversal. Whatever you really determine as a reversal, I just want to make sure that I'm not buying catching a falling knife. And like Felix said, I'm buying it 6 points down, but then I get stopped out 12 points down, and I lost my money. We want to wait until it hits that 15-point floor, and then we're able to buy it up back to 6 points. Something like that. So,
it's a good point. I would say that one thing, a trader told me a long time ago. He said, "Respect the V. Respect the V." If you see a V on the upside or a V on the downside, you got to respect that. Those are good points. Those are good entry points. But you also got to respect, and this is you learn over time, because you see the V, you get long, and then all of a sudden it starts trickling down. And if it starts the reality is it shouldn't get back to that V, to that point, to that down point. And if it does get down there and you get this double V, God bless you if you're able to hang on. But it breaks that V again, and it's a sharp move lower because you got a lot of people who've been trying to buy right there. So it's one of those things where, catching these falling knives is a bad thing to do. You'd rather buy it on the way up with a stop on the way down, or vice versa. But on the way down, it's usually worse. So, you're going to hit some floor at some point. At some point, you just got to lay off the computer and watch it and let it bounce. Let it actually bounce. And it shouldn't hit that point again. Like, you should never be able to hit the low. The low is made by TD Ameritrade stopping 1 million traders at one time, wiping them out. It trades to the low and trades back. It should not get to that low again.
Right, exactly. Hey, I just want to move on to our next question from Steven from California. Steven, I just unmuted you. Can you hear us?
Yep. Do you guys hear me?
Okay, awesome, Steven. Yes, I can hear you. Felix, can you hear him?
Yeah.
Okay, awesome, Steven. Why don't you go ahead with your question?
Thanks for having me, guys.
No problem.
Yeah, definitely. So I did have a few questions, but since we're kind of talking about the most recent current event stuff, unfortunately, I do have some like long options, kind of swings that I had in place already. So given the market's going to be down at open, and if it does get violent and drops hard, I'm just trying to see what are the best ways to kind of protect myself, and how do I kind of best come out alive out of this, if you will,
Let me ask you a question. So you have long calls. Is that what you said? Long calls?
Yeah. So right now, my two main long calls are, I have July BABA calls, and I have Beyond Meat calls as well.
Okay.
Next week.
What I would say is, one, you're probably the mark to market's probably going to be bad in the morning, right at the get-go. I would say this, if there's usually what happens in these scenarios, there's a bounce. Maybe there's a bounce tomorrow morning. So you walk in, it looks awful. There's some bounce. The problem that people have is that they will stick around and they say, oh, that bounce, my option was $3. It's 150 on the open or 140. Remember, the market makers will raise the volatility of the option, right? The whole market's gonna have volatility up, right? There will be people that buy calls in names looking for that bounce, right? They're gonna hold that volatility up. They will be paying the offer to say, because you're already long the stock, long the calls on the down, on a sharp move down. There's gonna be people that are coming in for calls, right? Because like Hope said before, every day the thing bounces back. So this is an opportunity to buy some calls. I can make some money on the bounce back. What happens is the volatility is very high. Okay, so in cases like these, if you think, look, it's up to you, but if you think the market's going to go back up, and this is that moment where it's like, oh, it's great, then you hang on. Maybe you're too big and you let them go. But usually the best time to let it go is on that first move back up. So what happens is that on a sharp move down, volatility goes up. All options expand, calls and puts. So while you're going to lose on direction, you make a little bit back on the volatility, if that makes any sense.
Yes, that makes sense.
So you're going to lose on the direction, your delta. You're going to lose on the direction, those calls, but you're going to make a little bit up because just in general, the market has expanded the calls, right? They expanded the puts and whole board. And what happens is if it keeps going down, your calls are going to go down with it. Okay, so you're going to lose there. And what happens is if the stock rebounds and starts going back to where it was or where it opened, what happens is you won't make any money on those calls. Those calls, they opened up at $1.50 and the stock moves back up $2-3 or whatever it is. Those calls won't go up from $1.50 to like $2.25. Okay, what'll happen is the market will start taking out the volatility. Okay, because the stock is sort of regaining, and you don't really make any money. So on the downside, you're going to lose the rest of the $1.50, and on the upside, if it goes up $2-3, what happens is you only make like 15 cents, and you're wondering like what happened, right? And so when you're long calls in a scenario like this, and if things go down, if there is a move back up, and you are lucky to get out at taking a small loss and regrouping when things get a little calmer, that's usually the right play. Usually, I haven't looked at Bob and where it is. I know that it's come off from the highs, but usually that's the play. And again, it's very simple. Market opens up, volatility high. Your options have come down. On calls, you've lost money because the market's down. So you've lost money on delta, but because the market volatility is higher, that your volatilities are going to gain a little bit on that volatility. And so you would have thought, oh, I had a $3 option. It should have been $1.10, but it's actually $1.50. And then you see the stock reverse and it starts going back up, and $1.50 goes slowly to $1.55, slowly to $1.60, slowly to $1.70, and the stock is ripping. But the market makers are not giving you that credit, because what they're doing is they're taking back that volatility, and then the delta you're still down on. And so what people get confused in days like today, and usually the best time to get out is if, I probably should have been down a lot more. I'm going to take a small loss, regroup, and kind of like that's usually my best advice to people.
Yeah. So it wouldn't make sense to almost like kind of buy puts, or even like turn it into a credit spread or anything like that, as such,
Yeah,
Go ahead, Sean.
Yeah, if I can just jump in here a little bit on the options or the abilities you have with if you want to incorporate potentially selling options and spreads, and if you're looking to hedge your position, you're saying, you said, oh, I have June BABA calls, right? You still have until June. Those are pretty, far out. Maybe you want to take on a short-term hedge because there's potential short-term volatility in BABA, but you're still very confident in your long-term options. I'm not sure if that's the case, but say that's the case. You're still confident in your option, but you want to decrease your risk. Something you can do is you could sell a call with, I believe it's I would probably be a lower strike price depending. And what you would do is you would create a credit call spread. So for example, you're long the BABA, I don't know what it's trading at, say $200 call, right? If you you say, oh, there might be some volatility, you could potentially sell the March 20th 197.5, right? And what we're trying to do is we're trying to have the stock stay under 197.5 by March 20th. We'll collect that credit that we receive for opening and selling that option to the buyer, and then we'll be left with the back week or back month per se BABA call. So there's many different ways to do it. I know Oliver, Vishu, I'm sure you could just ask one of the moderators in the chat. They'd be more than happy to help you. If you need any help, I can run those long options through the options chain software that we release, and I can give you some feedback a little bit on maybe what that target price is, what the percentage is, get you some more information on those specific contracts that help you out there. But if you just want to maybe shoot me a message, and I can run them through, and then you can see kind of maybe Felix's take and what the top 1% would really think about your option, if that makes sense.
And here, one last thing I would say, Steve, right? Steve?
Yes. Hey. Yep.
Let me ask. I should have started by asking you the question. What was the plan before you got into the trade? You were going to buy it at this price? Yeah, the BABA. You were going to buy it at this price? What was the plan?
Yeah. So I actually had this price target for the July 17th 210 calls for a while, and the reason I kind of saw that was because I saw it in the flow, and there was big volume in the flow. So I kind of had this price target for a while, and unfortunately, I had stuck there and just it triggered on the drop on Friday.
Gotcha.
So I had a $17 price target for $17.50 for a while.
If your plan if your plan's in place and you bought these calls because it was going up and you get stopped, on to the next trade. So remember, what I teach at 3 Steps to Profit and at OptionsGeek.com is you have this plan before you actually trade the option, right? Before you actually trade the option, you have a plan. I'm going to get out here. I'm going to try to exit up at these 2 or 3 places, or I'm going to do this, and I know what I'm going to do. And the reason, it's very important to understand, and this is a great lesson just today. I mean, you're living it, right? What happens today is you look at the market, it's, you were down 40 handles or 35 handles, whatever, in the SPOOs. It's emotional, right? It becomes an emotional thing. Like, tomorrow, what do I do? I'm down. Well, if you have a plan, you know what you're supposed to do. It's very simple. If your plan said, you know what, down 50% on my option to sell it, or down 40, whatever your plan is, and it happens, you sell it. And you don't think back if Baba then rips up to 230 and then you go, oh, I should have stayed. It wasn't the trade, right? It wasn't what you thought happened. Either that, or you were too big in the trade to get bigger when it actually moved against you. So that's the plan. The plan is to sort of say, you can't look back and say a month from now, go, if I would have just held the Baba calls, I'd be a millionaire. Doesn't work. Life doesn't work that way, especially not in trading. So if you start with a plan and then you could see that, I'm getting stopped out too fast, then you might start thinking about lowering the notional on that trade, on each individual trade. If you're getting stopped out, then I would look at the process of how you pick that entry level, right? So the plan helps you not just in actually thinking about the trade when SPOOs are down 40 and reducing this emotion. It helps you in understanding what's working in your process. You might just be picking bad entry points in Baba. You might be, I might say to you, it has nothing to do with the options. It has more to do with who's teaching you technical analysis. Like, let's freshen that up. Let's figure that out, because the option analysis is correct. You just happen to be wrong on Baba technicals. That's all. It's not, and then you just move on to the next trade. So I think that's why it's important to have a plan. At OptionsGeek.com, that's always, we stress the ideas will come, but it's really the plan that's going to extract the profits. And the plan is there to reduce the emotion of something like this right now.
Yeah, that makes sense.
Awesome, man.
All right, cool, thanks. I do have one more question, if I may. So you did mention your SPY puts, right? And you're saying that it wasn't priced appropriately, and just given the risk that was on the table. So how did you kind of come to that determination in terms of the pricing of the SPY puts and kind of looking at the broader kind of macroeconomics that's happening?
It's very great question. It's as simple as putting it in the machine. I built a machine to think, to do all the options analysis for me. So I didn't have to start crunching numbers when I had a thought. My thought was, I looked at the SPY chart. I saw what was going on in the market. I looked at the SPY chart. Where is it going? Where could it go? Right? Where could it? We all know what's going on in the market. Now I'm looking at the SPY. I see my favorite setup. Wow, MACD diversion. It looks perfect here. Where can it go? I'm looking at the board. I just clearly see 320 looks like a clear spot to me. 320. If it gets to 320, it's going to 315, probably really fast. Okay? So 320 is my level. So I literally just go to my options tool. I stick in SPY. Now I got to stick a date. So I say, you know what? February 28th is the end of the month. A lot of things happen usually at the end of the month. Things tend to move a lot sometimes. And the first of the month. So for one extra, for a couple of pennies, couple of shekels, I can get the Mondays, which is the first of the month. So I get the last of the month and the first of the month. So you know what? To me, I consider those events. The last of the month and the first of the month, to me, those are kind of like technical events. So I chose the March 2nd, not much more expensive, would seem like more expensive than 1 day is not going to make a difference. And I just literally put 320 into the options tool, March 2nd, and it spit out the 330 puts. That gives me the best edge on the board. That was it. So I built this tool to sort of get rid of all the analysis and anything I need to do. And it's built to think exactly like the top guys in the world think when they're thinking about risk reward.
Yeah. And what I would say is just, sorry, Stephen, if you want to get a little bit more information on how exactly this works, because I know we can talk about, just plug it in the machine and it works, it doesn't make that much sense. We have an entire overview video, which we did. You can go to the announcements channel in the Discord server. last Monday at 7
Mhm.
p.m. we posted a software overview video. You can go see it's actually it's Felix's voice and everything like that, and you'll get everything you need to know about that option software. And keep in mind that it's how you choose the right option. I put it. I
Yeah.
played Pfizer, I played McDonald's, I played Activision, and I all use that as my best naked options trade that I've ever made using that options tool. And I'm going to be completely honest with you. So just take
Do
a look at that
members
video.
have
Maybe that
access
would
to
help
this
out.
tool?
Sorry, go ahead.
Do members have access to this tool as well? Like paying members, do we have access to this tool as well?
Yes.
Or
Yes. So members who are in the 3 Steps to Profit membership will have access to this tool. I know, for example, we have Jeremy on the call, and we answered Jesper's question earlier. They do have access to Felix's software and tool, which he made.
okay.
Awesome.
Right,
So
cool. Thank you.
I want to move on. Stephen, hey, I appreciate your question. Thanks so much for taking the time out. We are actually going to move to another Stephen, Stephen from Massachusetts. He had a quick question for us. Let me.
Yeah, I was checking out the tutorial video on the options chain, and it was really interesting to me. And I just had a quick question about the strikes that were shaded and the strikes that were not. Could you explain that for me?
Absolutely. The most important options tool is the options chain. And as you saw in the video, I was trying to get people to understand that the information that is given on that chain is incomplete, right? And so what you see in that video is what I call the RR dollar, which is the risk reward break even price. And that risk reward break even price for the first time takes mathematical edge and sticks it into this options chain to sort of give the user a visual of where the market is pricing in the risk reward. I like to think about it as, if you like sports betting or whatever, it's like the over under, right? The market's giving you the over under on each individual strike. And what I then did was I shaded certain areas, and the areas that are shaded are the areas that are unshaded, right? I call it the window of opportunities, right? That's where the top 1%, that's where the biggest guys in the world, they look for opportunity. Okay. So if you take a step back, the top 1% are generally buyers of options. Okay. 2, they buy option when the risk reward is in their favor. 3, they're buying options because they want leverage. Okay. And the out of the money options, the 25 to 45% probability of being in the money, that specific area is where they're hoping to find opportunity. Now, how do they find opportunity? They only find opportunity when they stick where they think the stock is going and mess around with the confidence bar. And if that pointer lands in that window, then you have yourself a trade that the top guys in the world would look at and say, that's a great trade. I want to do that trade. Obviously, the computer's not going to give you the idea. What it's going to do is give you the analysis. So, for example, on the SPY trade that we just talked about, I came up with the idea. I looked at the idea. I want to use options. I'm asking myself, is this an options play? Is my idea of where I think the stock is going, is it built into the price already, right? Because that's what we don't know. Is it built in? So I put 320 in the options chain. I put my target stock price. I raised my confidence to higher because it was a higher confidence trade for me. And the pointer landed right in the window of the puts at 330, which was unshaded. And I thought that's a perfect trade.
Okay, so the ones that are shaded, it's safe to say that they're too expensive. The risk reward just isn't there.
No, sorry, no. And I'll clear that up here. If the pointer lands, if the pointer just shows up, it could show up in a shaded area. What I wanted to do was I wanted the top 1% guys, they're very, very, very specific. So I just wanted to highlight where they buy. It's sort of like at OptionsGeek, I'm teaching everybody, you can trade however, there's a lot of people that trade options, but the top guys in the world, they're looking right in this area, and they're looking for opportunity right in that area. Now, if the pointer pops up on an in-the-money option, then that pointer is essentially saying that option in the money, whatever it is, it's shaded, but that option fits your point of view. The only problem with that option is that the top guys in the world, they wouldn't buy that option. They would actually probably buy stock. Does that make sense?
Okay. Yes, it does. Thank you very much.
Good. If you have any questions, obviously you can email me. We can go over it further.
All right. Thanks, Felix.
Felix, I have a quick question for you just to
Yeah.
build up on that is that, I use the tool very often and I see that, okay, I want to buy the options that are not shaded, right? And only if my pointer aligns with my criteria, et cetera. The options that aren't shaded, if I look at it from the inverse perspective, right? So if I'm a premium seller per se,
Yes.
would you say that maybe those shaded options would be
Yes. Those are the ones you want to be selling.
sellers? Exactly.
Yeah.
So I've been
Yeah,
using it the opposite way as well.
Well, right. That's why I say I'm showing it from a buyer's perspective. But if you find some now, let's take calls. If the pointer lands above the window of opportunity in calls, what it's basically saying is that usually the top 1%, they're not buying those because that's giving them a signal that it's a little far out. The market's not dumb, and like you're being pretty aggressive with your target stock price. But if the pointer's not in the window of opportunity, then that's a window of opportunity for sellers. So if the pointer doesn't reach the window of opportunity, then your view is basically that your view is the market's view is that the stock could move a lot more than you can move. So you would be a seller of those options. And it allows you to then, for example, in a stock, if you think, $100 stock, the window of opportunity is right around the 104, 106, and you put in your target stock price and the pointer is at the 100, 101, those 104s, what you might have thought, well, I don't think the market's going higher than, 108, now you would say, I want to sell the 108s. Now that tool is saying you could sell the 104s, 106s, 107s because, that's going to give you more premium and it's giving you a better risk reward than selling the 108s. So it's sort of like telling you that you could come down and strike and play the probabilities.
Wonderful. Yeah, Felix, that makes complete sense to me. And I was trying to look at the tool and hey, how can we always continue to innovate it and look at it differently?
Absolutely.
And it works.
Yes.
And it works two ways. And that's the beauty of it is like, I looked at it and, Felix, when I first met you, I'm like, oh, he's all about buying options, I'm a premium seller, and I sell premium. I also buy options, right? Yeah. But how can I use this to learn how to sell options? I just look at everything the exact inverse of.
That's right. Right? And the interesting thing that you play around with that tool for 5 minutes, and the first thing you say is options are pretty expensive. Like if I'm not hitting that, like I really got to think the stock is going to move in order for this pointer to land. And that's when I say, aha, you got it. That's why hedge fund managers have 100 stocks in their portfolio, but they only use options on 5 names or 3 names. That's why, because the options have a lot of movement built into them. And so if you're not hitting in that window, and it's hard, once you start playing around with it and you're like, man, I need to think that the stock is going here. Yeah, that's the game. And if you can only play in situations where you're hitting that window and you're comfortable with how you're getting that target stock price, you'll be able to leverage those options very, very well.
OptionsGeek.com and Eagle Investors is partnered to create a 3 steps to profit comprehensive membership. Everything that you need to trade options like the top 1%, like Felix. We have a comprehensive options education course, options chain software, which we were just discussing. I know previously we also mentioned our unusual options activity option bot, which also has technical analysis built in and many other things as well. In addition, you get Eagle Investors membership, options alerts, trading alerts, and what I would say is customer service and us to be here for you to help you throughout your learning process to become a successful trader.